Welcome to this class on the topic of capital budgeting. Essentially, as you will see as we work our way through the class, we're going to look at issues associated with investment and issues that concerns the programming of investment within the overall objectives of the business. So, what is capital budgeting? Well, it's the process of evaluating and selecting long-term investments that are consistent with the firm's goal of maximising the owner's wealth. Presumably the owner wants to get richer. Not necessarily the case, but it may be the owner's very happy with the business as it is. But generally speaking, we tend to think of investors or business people as people engaged because they want to increase their wealth. And for companies to survive in the long run, they must invest and reinvest. Assets run out, assets need replacing, and so on. So there must be some sort of plan, a capital budgeting plan, which enables the business to move from one time period to the next. There's from our perspective right now, two types of expenditure here. There's capital expenditure, which is known as CapEx. It's the outlay on items which produce benefits over a longer period of time, usually more than a year. And we've also got the operational expenditure, OPEX, and these produce benefits usually within a year. So some sort of investment which produce benefits in a short period of time. So really the difference between capital expenditure and operating expenditure bubbles down to time periods. Capital expenditure being the longer of the two. There are other names for the operational one. There's operating expenses, operational expenses, and operational expenditure. That's just a minor point, but it does come under different names. It's the same thing. Now, what are the difficulties in capital budgeting? Well, the first one is that the future is uncertain. We can't tell what the future is going to be, and it's therefore almost impossible to work out what the stream of benefits from an investment will be in the future. There are lots of techniques in the literature suggesting that we can look into the future, forecasting techniques, statistical techniques, all sorts. But the upshot of it all is that the future is uncertain, and we don't know what the future is going to be. If we knew what the future would be, we could predict it precisely, then I guess the world would be a different place. But we don't know what the future is. That's the first problem. And we can't compare costs and benefits over periods of time anyway. We know what the cost of a machine, perhaps if you're investing in a machine today, we know what the cost of the machine is. But the benefits come in the future. So we need to discount those benefits back to the present. That's difficult. It's difficult to work out what the present value of a sum of money you're going to receive in perhaps 10 years' time is going to be. Almost impossible to work out. And there are non-quantifiable costs and benefits. Having an investment may fit in with the overall profile of the business, but it may not be central to what the business is doing. It depends on the nature of the investment. So, what's the rationale for capital budgeting decisions? Well, capital budgeting, by getting new investments into the business, by making plans that go into the future, a more efficient business could be designed. It can emerge from the whole process because it's much more rational to think this is what the stock of capital today is, but that's what we'll have in the future, and it'll be much more efficient, better planned and better laid out and better designed. It may expand revenues. It may be that it's possible to buy a new machine that does some extra function which will make the product more attractive to the consumer, and hence more will be sold. It may be the case, it may not be the case, but it's a possibility and worth bearing in mind. Certainly it's the case that capital budgeting decisions try to reduce costs. There's always a quest on in nearly every business to try and reduce costs. Reducing costs are key to business success, controlling the costs and perhaps reducing them. So future investment decisions are aimed mostly to reduce costs, aimed at this idea of reducing costs and bringing about greater efficiency, as I said earlier. Now let's distinguish between capital and operating expenditure. Well, let's just put in a little table here and just very simply just run through the table and see what we've got. So let's say we purchase a photocopier. Now, is a photocopier capital expenditure or operating expenditure? Well, capital. Chances are we're going to have it for some time. We're not just going to have the photocopier for a very short period of time. Perhaps it's a long-term thing. Maybe a contract is for 4 or 5 years or whatever. The purchase of paper and toner for the photocopier, well, that's operational because short run. That depends on the day-to-day usage of the photocopier. The cost of power and maintenance, well, short run. So it's an operational expenditure. Depends on how much or how intensively we use the photocopier. Now, if you're going to make a big decision like establish a new plant, a new business, a new production facility perhaps, then that's capital expenditure because that's, generally speaking, takes a long period of time, a lot of decisions, a lot of resources, a lot of planning. That's capital. It takes a long period. The wages to the workers in the new plant, well, those are operational because workers come and go, and it may be possible to even substitute capital for labour in some respects. So workers are operational. It's an operational cost. The acquisition of a firm, well, you've probably guessed it by now, but that is capital expenditure because it's long term. It's a big decision that has ramifications into the future. Training of workers, well, that's operational. So we have a little table just to suggest to us what the difference between the two are. There's a last one here, which is training the sales force, obviously operational expenditure. So the little table just sort of enables us to tick off what's capital and what's operational, and it really bubbles down to time periods. Capital expenditure being more long-term, usually more significant investments involving more resources. Operational expenditure, day-to-day type of expenditure. Steps in the capital budgeting process. Well, first of all, you've got to propose what the investment will be. You've got to review and analyse the situation, the current situation, to see if it's a good idea and see what is available. You have got to go through a decision-making process, bringing the analysis to under scrutiny by management and by all the stakeholders who are involved in the business. Once you've made a decision, then it's got to be implemented, and the process of implementation has to be set up, agreed, and worked on. And then to ensure that the implementation was effective, there's got to be follow-up. So those are essentially the steps in the capital budgeting process. Now, what are the key motives for making capital expenditure? Well, to expand the business. Yes, making a further investment does expand the business. It could be to replace existing capital. Perhaps it's worn out or becomes obsolete. perhaps the market trends are such that a new technology is required to produce something. So you have to renew the capital perhaps. So it's not just replacement, it's renewing existing ones, like for like, or getting a completely new replacement, perhaps a new machine with a new technology. Or it could be just the same machine, simply because it's worn out. We also have these ideas of inorganic growth, this idea of let's just expand the business, because the business is not moving at the moment. We need to make a new decision, perhaps diversify the product range, open a new plant. Inorganic growth. It may be that there's new competition for the existing product and something new is required, perhaps foreign competition, who knows. And as a part of the survival strategy of the business, long-term investment must be made to ensure that the business moves forward. Now, the basic terminology here is we have independent and mutually exclusive projects. Independent projects which are not related to in any other type of investment that the business is making, and mutually exclusive. We'll talk our way through those in a few moments. We have unlimited funds and capital rationing, and we have accept, reject versus ranking, and we have conventional and non-conventional cash flows. Now let's look at the independent and mutually exclusive. I said a moment ago, it's the independent tends to deal with one investment which is not connected to any other investment of the same type within the business. This would be it's similar to talking about green fields investment, something new, something different. It doesn't necessarily mean moving out of the existing sector. If you're producing cars, it may mean you start to produce some component for the cars. So it's slightly different. It's independent in that sense. It could be used in all cars, not just your own car, but it could be used in your own car. So it's independent nonetheless, because it could be used in a variety of ways. Mutually exclusive, projects that compete with each other, so that acceptance of one eliminates further consideration of all other projects that have similar function. So it's mutually exclusive. If you have one type of investment, then you can't have another, because it would be silly. It would be competing against itself. So the projects have to be mutually exclusive. If you have one, you can't have the other. Unlimited funds, well, before an investment takes place, there must be funds available. To say there are unlimited funds, not always the case. Normally we have a situation of capital rationing, where a financial situation in which a firm has only a fixed amount of funds available, and there are numerous projects competing for the funds. So it has to ration it. It has to say, we've only got a small amount of investment money here. We have all of these really good ideas. We'll have to rank the ideas, look at them carefully, and ration out the funds to make the best of what we've got. Accept and reject, well, you look at the project proposal and you accept it or you reject it. There's nothing in the middle. You don't say we will half invest, or we will set up the facility to bring this online in the future, or you just accept it or reject it. And the ranking approach looks at the best scores, what's the most likely to succeed, and it tries to rank the various projects that are possible in the future. It ranks them as the best, the next best again, and so on and so on. And then it picks the one that's most suitable. Conventional cash flow patterns, well, these are just the cash flow that you would see in a cash flow statement. They are the normal run-of-the-mill, perhaps cyclical or seasonal cash flows that the business would expect. The non-conventional ones are caused by the initial outflow into a capital project, which costs perhaps quite a bit of money and would enter into the cash flow because it will significantly dent the cash flow for that particular time period. So it's not conventional. It's an unusual thing that happens. People don't make decisions to invest every day. People don't make decisions to spend a lot of resources all the time. These are things that just come up once in a while. Incremental cash flow and resulting inflows associated with the business, well, these will appear in the cash flow statement. There'll be the initial large outgoing to make the investment, and then over a period of time into the future, the cash flow will benefit from receipts from that investment. That's just saying what I've just said. So it's the additional cash flow or inflows which are expected as a result of the capital expenditure. The major cash flow components were, well, the initial investment, that's the outgoing, the operating cash flow, cash incomings. So having made the investment, the outgoing, then you reap the benefits in the future, so there's a cash inflow. And at the end of the time period, it may be able to sell the investment or even get some scrap value for the investment if it's not capable of producing any more. So the initial investment is the outflow, and you could say that happens at time zero. When it happens, at that moment you say, well, okay, time zero, and then the inflows are measured off that. The operational cash inflows, the incremental after-tax inflows resulting from the implementation of a project during its lifetime. So initial outflow and then the subsequent inflows. The terminal cash flow, well, after tax, it may be that the investment could be liquidated, turned into cash, perhaps scrap value, or it could be sold on, or it could be sold off to be re-engineered or patched up, or so there may be a terminal cash flow associated with some capital venture. The cash flow for expansion decisions, well, there's the initial investment, the operating inflow, and the terminal cash flow. We've already talked about those. The cash flow for replacement decisions, well, it's complicated. To make a cash flow for replacement, to look at an investment to replace an existing asset, requires a decision. Do you replace with exactly the same as before, or do you innovate? If you innovate and bring in a new product, if there is one available, there may be training implications, manpower implications. There may be additional costs that perhaps need to be integrated into the decision-making process. All of the outflows and inflows need to be identified. Put the cursor on here just to emphasize that number 2. It may be the case that the outflows and the inflows are not immediately obvious. So it's a question of doing the research before the capital investment is made to ensure that there's good knowledge about the implications of that investment in terms of the outflows and the inflows over a period of time. The terminal cash flow is one that many people emphasize because it's nice to think of an investment as something that's going to run and run and run, and then presumably sometime in the future just stop. But there is an implication. There may also be decommissioning of the asset, which may involve a further outflow. It may be that the asset needs to be disposed of. Nobody wants to buy it. There is no scrap value. It just needs to be disposed of. In which case, there may be future obligations on the cash flow to deal with this asset. This is obviously the best example of this is in the nuclear business, where there's the initial investment in a nuclear plant. There's the benefits of the life of the plant in terms of electric generation, but at the end the whole plant has to be decommissioned, which is very costly. Cash flow estimates involve tax, and they involve the effects on other projects, the indirect expenses, and the effects of depreciation. So when you look at a capital investment, you need to take those 4 points into account. What are the tax implications of the future revenue? What's the likely government response to the investment anyway? What's government policy going to be in the future? Is it going to increase taxes, corporation taxes, or is it going to give grants for people who are investing in this area? I mean, what exactly is the government stance? There's the effect on the other projects. The project perhaps needs to be integrated into the overall production plan. And what's the effect on indirect expenses? The expenses of the business will be affected by all its components, including the new investment. And how will it be depreciated? Finally, we have this idea of the sunk cost. Once you've made an investment decision, sometimes that's it. It's a sunk cost. It's there, and there's nothing you can do about it. You have to make the most of it. It's not as if you can reverse the decision, perhaps in a year's time, and say, we've made a mistake and we'd like our money back, please. You've made the decision. It's a sunk cost. There's also an opportunity cost. When making the decision, you have to decide, is this the best way to use the money, or are there other investments which would have been even better? So there's an opportunity perhaps that's been given up by investing in a project. The opportunity of investing in a different project which might have been better in the long run. So capital investment, it's not a difficult topic. It's a topic with many facets, many components. Essentially, it bubbles down to making a decision to invest in the future and seeing whether that is profitable, and what components or what issues affect the likelihood of profitability in the future. Okay, that concludes this class. Thank you for watching.